let's get right into the word on Wall Street. Top investors watching your money. Joining me right now is Payne Capital Management President Ryan Payne, Mahoney Asset Management CEO Ken Mahoney, and the Fitzgerald Group Principal Keith Fitzgerald. Gentlemen, great to see you all. Thank you so much for being here. We've got a nice little rally underway this morning ahead of another big day for earnings. I want to get your take on that, Keith, in terms of where we are. Disney and Uber will take center stage after the close, and that earnings number on Disney is going to be important to watch. 96% growth year over year is what analysts are expecting. How would you characterize the earnings season so far, and what are you expecting?
You know, I tell you what, I love what I'm seeing in the earnings season because it tells me that the corporations are a lot stronger than people think. Disney is very, very hard to handicap in particular because it is really a classic pandemic story. It was hammered during the worst of the COVID is now coming out of that. Streaming, of course, key. They're moving against Amazon and Apple with regard to the NFL. They've got subscriber growth. They've committed something like $33 billion to content in 2022. But the key here is all the additional things. They've got the parks coming roaring out of the basement. They've got travel to get to the park, so we're going to see consumer behavior. And on top of that, all of the other brands. They've got Mattel, Pixar, Star Wars. These things are going to be powerful. I love the setup. It's underperformed badly coming into earnings today. This is great. You buy stocks that have been kicked to the curb with great potential. I love it.
Do you still like tech, though? Because look at a stock like Meta. Facebook is down 33% year to date. There's enormous amounts of pressure on social media and on big tech, even if we see gains this morning. Keith?
I think that's a great question. You know, I don't like all tech. I like the right tech. So to me, this is companies like Apple and Microsoft. Facebook instantly, Meta is one that I will not touch as long as Zuckerberg is at the helm. Not only are they under legislative pressure, but I think the company lost its moral compass arguably a long time ago. And I don't like to invest in stocks where I don't trust the CEO.
Yeah, all right, good point. That's certainly something to watch. Ken, I want to ask you about inflation. January's consumer price index is out tomorrow. We're expecting another spike in consumer prices. 7.3% year-over-year increase is the estimate, marking the highest inflation rate in 40 years. That's what we saw last month as well. What are you expecting, and do you think the markets trade on this tomorrow?
We're definitely going to trade on tomorrow. Look, Goldilocks, we know, left some time ago, right? We went to too hot. And the question is really going to be, you know, what this number is going to be. If it's hot, too hot, you could probably look at a 50 basis point increase at the March meeting. I think this number is really that important to determine it. 25 bips that we start, you know, in March, start the campaign of raising rates, or 50 basis points. And then if it is too hot, we're going to get this crazy thing. It's like a bidding war. Okay, I got 8 hikes. I got 12 hikes. I got 14 hikes. You know, it gets zany. We're in the 2 to 3 rate camp, quite frankly. We think the economy could buckle over after a couple hikes and that the yield curve start flattening or worse yet, invert. So we don't think there's going to be all these rate hikes. And we had to guess, though, by the way, because January, you know, a lot of demand waned thanks to the Omicron. You know, we may have a little tamer number than people are expected. That'd be great. But if not, look for all those analysts to start with the 10, 12, 14 rate hikes, which is pretty zany because the economy can't withstand that many hikes.
Well, I mean, do you think you could still buy stocks and avoid a big sell-off as the Fed does raise rates that many times?
I think so. You know, to echo our buddy Fitz over there, you know, look at Apple, look at Microsoft. There's a lot of companies that beat estimates, raise guidance, okay, and analysts are still behind. They're still raising price targets and upgrades and so forth. So again, if you're in the right names that are able to navigate this economy with the headwind of some higher rates, you're going to look for those companies that are beating estimates, raising guidance, and have a strong balance sheet. And by the way, that balance sheet, like Apple, guess what? Higher interest rates helps out the earnings just in that $200 billion worth of cash that's sitting around.
Yeah. Well, look, we were talking about a $3 trillion valuation on Apple. Ryan, we've talked about tech as a place to hide and to own. But look at Facebook parent Meta, down 33% year to date. What do you make of it? And what sectors do you want to own right now, Ryan?
Yeah, well, I think it also speaks to when you have high valuation stocks, they're going to be very, very sensitive to rising interest rates. But look, I mean, we're talking about interest rates. And Ken, I'm with you, man. These banks, they never get it right, these strategists. They fall over themselves to give you the most dire prediction about interest rates, what's going to happen in the economy. They never get it right. And that's why I have a job. So, you know, what I think here is we have to look at is going into the summer is the fact that we do have inflation and interest rates going higher is because the economy is doing well, right? I mean, we have literally consumers now. We get the vaccination rates are high. We've got a lot of people that have had the virus. People are like, you know what, I'm going to live my life now. So I see a very euphoric consumer coming into the summer. If you look at any polls out there, people are like, I'm going to spend money this summer. I'm going to go away. I'm going to spend as much money as I did in 2019 or more. And I think that's going to bode really well for the economy, but specifically hospitality and leisure. If you look at like the airline industry specifically, the airlines are going to be profitable again. Like look at Delta Airlines, they're going to be profitable in March. And if you start looking at their guidance, they're going to trade at like reasonable multiples. You're going to have more people on planes, whether it's for business or for leisure. So I think anything that is sensitive to the economy reopening, where people are actually going to have some fun and spend some money. You know, I said this on the show last week. We are going into the roaring 20s. You've got to embrace it. The economy is going to run hot, and a lot of companies are going to benefit from that. You got to be invested. And I do think tech, though, I'll take a step back here, has the most risk here because interest rates are going higher. We've already seen this repricing, so you've got to re-diversify your portfolio, Maria.
All right. Great comments there. Ken Mahoney, Keith Fitzgerald, good to see you, gentlemen. Ryan Payne, you're sticking with us all morning. We're happy about that. Gentlemen, thanks very much. Have a great day. We appreciate your time. Much more ahead coming up.